This is Chapter 20, Video 3. Let's launch. Okay, so in today's class, we're going to do make a determination, or we're going to determine the appropriate accounting periods for the and methods for the partnership. Generally speaking, when you're talking about this, there's a few things that you've got to kind of look at. So one of the things they're going to be doing is doing a lot of the elections, and so tax elections, so there's a variety of elections that a partnership is going to do, and not necessarily in the first year that it gets into business, but also in subsequent years of the business, it'll actually have different elections that they're going to take. Now, the tax matters partner does normally make the elections unless the rule requires a majority vote. And that's something that, I'm not going to go over them because, it would take an entire class to be able to do all the elections that are possible to a lot of the businesses. Again, the partnership will make the elections, but the partners will be responsible for the consequences of that. And that's usually why. Yeah, I mean, here's the thing. Yeah, legally, tax matters partner, whoever you elect in your group to be the tax matters partner is the one who's going to be legally permitted and responsible to make the elections that are necessary for the partnership to succeed. However, for a partnership to actually work very well, this is where you kind of need a little bit of teamwork. Yeah, the tax matters partner might do it, but it's very rare that you're going to see a situation where there's like a dictatorial power where the tax matters partner says, well, I'm just going to do whatever I want. So usually what will end up happening is in the operating agreement, they'll spell a lot of that stuff out. They'll basically say tax matters partner can make the election for all of the elections that are deemed necessary for the best interest of the partnership, with the exception of the following, blah, 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 blah. And a good operating agreement will actually incorporate a lot of that stuff. But it also depends, though. You have to think about it. Sometimes an operating agreement does not foresee what needs to be made and what does not need to be made. And that's just because sometimes businesses evolve over time. And so sometimes you may run into some issues where you're preparing the tax return. You're like, hey, look, we're doing some looking at this. We think if you make this election, it's going to save you some money over the long run. But you contact the tax matters partner, and sometimes the tax matters partner will be like, yeah, I got it. Just go ahead and do it. Or he's going to say, look, or he or she is going to say, I need to go confer with the other partners and find out how we want to accomplish this. And again, this is one of those things that the law says one thing, but sometimes it's like that old saying that they had in Jurassic Park, you're so busy dealing with whether or not you could that you didn't bother with whether or not you should. Sometimes that happens in these partners. And I've actually had a couple times in the past where we've asked tax matters partner, they say, go ahead, make the election. And then 6 months later, when they're preparing their tax returns, because, they were extended, the person kind of comes back and says, why the hell did you make this election? My tax person's telling me I'm getting hurt, really hurt on this. And so that can actually be a little bit of an issue. Sometimes that requires a little bit of socialization that you will have to do as the CPA, especially if you're the partner who's involved with it. But getting back to kind of some of the different types of elections that are really big that you'll see: overall accounting method, election to expense portion of the organization, startup costs. Generally, that's not a very controversial one. If they make it, they're like, oh, I get an immediate deduction. I'm fine with that. They'll definitely do it. Now, if they want to go ahead and expand that out, usually if that's happening, it's because the CPA is telling them it's better for them to do it at that time. And then there's also the election to expense tangible personal property, under 179 or 168, where we're kind of doing the bonus depreciations. Again, that one I think actually could get you into some more trouble than others, just because, say for example, you buy $200,000 worth of property, okay, and we'll say under the 179 you could expense all of it. Under bonus depreciation, you can expense all of it, but you file the tax returns and say, for example, you live in New York where bonus depreciation is not allowed. Guess what? You may have a situation where somebody's paying a boatload of taxes to the state of New York, and they're kind of like, why do I have this add back? Well, it's because of bonus depreciation. And then the tax person, for the partner, is going to their person trying to take care of them like they should. And I'm not saying that this is wrong. They kind of go, well, why did your CPA for the partnership elect to do bonus instead of 179? If they had done 179, we could have taken a little bit better on this. And so that's usually when you can run into some trouble. Accounting methods, again, partnerships are required to use the accrual method if they have average gross receipts of over $26 million. It is indexed for inflation. I still remember when it was a little less than that, and it's been growing over time, obviously, as inflation does. One of the things about this, we try very hard, especially with partnerships and small businesses, to get them on the cash method, mostly because we want them to be able to have the cash available to pay the tax that are going to be due, as opposed to, kind of sidelining them and saying to them, hey, you owe this huge tax bill, you have no cash. You got to do it. Now, again, if you got $26 million in average receipts and you can't manage your cash appropriately, probably got some other issues. But that's just kind of when, you're going to have to deal with all of that. Okay, so let's talk about deferment. Okay, and when we talk about deferment, this is a topic that ends up happening when we're electing the tax year. And if I have 3 people working together as a partnership, this is generally not a problem. And here's why. Individuals, like we said in the past, generally, like I said, I don't have a lot of experience seeing otherwise, they're going to be calendar year, okay, unless they have like a business that they do on the side that force them to go to a different year. What will end up happening here is this. You're going to have to choose a tax year that's going to fit it. Now, if you've got 3 individuals, they're all calendar year, it's stupid easy. You use the calendar year. However, say, for example, instead of that, maybe you have a situation where you have 2 corporations and an individual working together, and say 2 of those two corporations both have a fiscal year. What ends up happening is there's a process that you have to get to. Now, here's the reason why the IRS has a problem with this. Say, for example, everyone's on calendar year, and you go ahead and you say, I want to be fiscal year. And I want to move my year from 12/31 to 1/31. What'll end up happening is that because your year doesn't end until 1/31, 1 month later, again, this is that artificial construct we have called the calendar that's based upon, the earth going around the sun, not necessarily based on when people pay taxes. You'll actually file your tax returns and it'll actually go with an 11-month deferral, if you think about it, because of that. So, and that'll end up happening, and it'll be constantly an 11-month deferral. And so what ends up happening with this is because, and you might say, well, wait a minute, they're only moving 1 month. How does that happen? Here's the thing. Every one of your people is calendar year, say, for example. And then you have the partnership has 1 month in advance. They prepare their tax returns. They file the K-1s, and we'll say that they get them out on time. So they get them out on April 15th. Because remember, they're 1 month in advance, so they're going to be 1 month of advance of what a calendar year would be, which is normally March 15th. Now it's April 15th. What ends up happening is that K-1 doesn't go on the person's tax return until the following year. That's where you get the 11-month deferral that takes place. And so as a result of that, the IRS kind of, the first thing the IRS is always saying is, why do people want to do this? If they have a legitimate business reason, they can understand it. And this is where one of those things, you'll have the automatic rules, and then you can contact the IRS using a Form 3115 and request a deferral, a change of accounting to a different year end. But you got to explain yourself. Okay. And if the IRS doesn't agree with you that there's a business sense for doing this, they're going to deny it. And the biggest concern that they have is people are going to play shenanigans, and they're going to try to get that 11-month of deferral. Now, some of you might say, well, what's the deal? You're going to pay the tax in 11 months. So what? Time value of money. And then the other issue that you run into is, like I said, the IRS is kind of like J.G. Wentworth. It's your money. Get it when you want it. And the IRS wants it immediately. So having an 11-month deferral on something, that's a significant amount of time. And so they don't want to be able to do that if they can avoid that. So 2015, I'm sorry, Exhibit 25, sorry, steps to determining a partnership's year end. It's a really good thing. And actually, this is where, when I was actually preparing for this class, I don't do this too much. So first of all, let me back up. I don't do too much of this deferral stuff. Most of my partnerships, they're all individuals. We use calendar year. We don't even have a discussion about this. But when you're setting up a partnership, and you have, say, an individual and two corporations, or you have three corporations that are just going to form a partnership together, what ends up happening is you could have a situation where you're like, we've got to, there's a default year that has to get changed, get chosen at the first of the year. Now, if you go ahead and you elect to do 1 year, one part of the year, and you just do it on your tax returns, that could lead to what's called an impermissible method. So the IRS came up with these rules in order to make sure that that taxpayers were understanding when the method would be best to be used, and not just best, but required to be used in order to. And the IRS's goal here is to reduce the amount of deferral. They don't want people just simply doing this for deferral. Okay, so if and they say here steps to determine does a partnership use a majority interest? I'm sorry, is there a majority interest tax year? So, for example, I have a partnership where Corporation 1 owns 60%, Corporation 2 owns 30%, Corporation 3 owns 10%. What ends up happening is that Corporation 1, because they're a 60% tax year, whatever their year is, you're going to use it. That's just it. Okay. If not, do the principals have the same tax year end? So if I have a situation where I have 33% for one, 33% for another, 33% for another, and all of mine use the same tax year, say they're all calendar year, we use the calendar year. Say all of them use 4/30 as their end of the year, we use the 4/30 as the end of the year, because what ends up happening is you have basically where all the partners are using the same tax year. If they don't, then what you're going to have to do is you're going to have to do a calculation. And if you take a look in your book on example 20-13, it's actually going to be on page 20-16 in your textbook. This is really good, and you might want to know this. In the past, I've not put this question on the test. I probably will do so this time simply because of the fact that it is something I think that needs to be understood. I think accounting periods are going to become more and more prevalent in the future, particularly as we have unique business opportunities that are offering itself. And I'm noticing that I've actually had a couple questions on this. I've never actually had to deal with a tax return where I've had to deal with this. But I've had people who have asked me, hey, I'm trying to figure out a calendar year end for the partnership. How do we do this? And this was on CPA Connect, which is a group that I belong to of CPA firms all over the nation. And so I've gone ahead and I've actually, this is one reason why sometimes you still want to keep your textbook, because luckily because I was teaching this class, not this class specifically, but I was teaching, this was about a year or two ago. I actually had the textbook from that year and I was able to go through it and say, hey, look, this is what you need to do, blah, 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 so on and so forth. Because what will end up happening is when you get out of school and you go work in a CPA firm, and then 10 years later, you go ahead and you say, hey, I'm going to go ahead and set up my own firm. What ends up happening is that you start running into things that you wouldn't run into normally. Sometimes because the firm that you would have worked at, they would have handled this at the partner level. And some of the reasons why is because some of the stuff that you're handling is just unique. And then all of a sudden you become really good at it. Then you're the expert. Then everybody wants you to do it. So that's actually very important in that sense. Okay. So that's all I've got to say for this class today. I want to say thank you very much. If you have any questions about this, put this in the comment box below. I'll be happy to respond. And if you have any other more detailed questions you have for me, go ahead and reach out to me at my email, and I look forward to seeing you in the next video.